Let's talk today about life insurance and specifically whole versus term life insurance. Now, as a general concept, life insurance is a policy, it's an insurance policy, which is designed so that if you were to die prematurely or at all, depending on the type of insurance, people who depend on your income, individuals that you designate, would receive money. That's the idea. You pay something, and then if you die, someone is paid what is called a death benefit. Now, term life insurance is probably the simplest to understand. It's called term because you buy it for a specific term, a specific duration of time. Could be 5 years, could be 10, could be 20 years, whatever it is. And then once that time is up, the policy expires. So one of the big differences here is we are talking about specific duration, whereas with whole life, we are talking about, sometimes it's called permanent, but it remains in place indefinitely. Now, why would you want to look at term life insurance? There's a lot of reasons why. Say you have a 10-year-old child and you want to make sure that they would be able to live comfortably for the following 10 years if you were to die prematurely. You don't think that they necessarily need to be helped once they're 40, but anytime between their age 10 to 20, meaning from when they are 10 to when they are 20, over the next 10 years, if you were to die, you want them to receive a death benefit. That would be one usage of a term policy. Another example would be you have a 30-year mortgage and there are 20 years left on that mortgage, and you are the primary earner in a household, for example. If you were to die and the household were to lose the ability to pay the mortgage, you don't want your significant other to have to sell or move out of the house. So for the same 20 years that you have left on the mortgage, you get a 20-year term policy for the amount of the mortgage plus some additional. Okay, that would be another way to use a term policy. The advantage of term also is that it is cheap. I mean, there's really no other way to say it. It is comparatively, we'll call it cheaper per dollar of death benefit, whereas whole life is more expensive. It's not atypical for a term policy that you could have. If you are a 30-year-old, you could get a 20-year term that would have a $500,000 death benefit for somewhere between $20 and $30 per month. This is nice, simple, and clean. 20, 30 bucks a month. If you die over the next 20 years, whoever you designate gets $500,000. If you want a larger death benefit, you can, of course, do it. That will increase your premiums. Maybe you would be able to get, a $1 million policy for somewhere between, $38 and $55 per month, or whatever the case may be. You'd have to investigate that. For a lot of these, you need a medical exam. If you have particular health issues that can raise your monthly costs, sometimes you can be uninsurable. Not everybody, depending on what type of insurance it is and specifically where, the medical exam can vary. Now, the term can run out, right? What happens? It's 20. You bought a 20-year term. 20 years go by. You didn't die. In a sense, you wasted that money. Now, those who want to sell you whole life will often make that case. Well, you wasted the money. You paid 20, 30, 40, 50 bucks a month. You didn't die. You just threw the money away. But that's how insurance kind of works, right? Listen, you paid for car insurance, $1,000 a year for 10 years. You never used it. You never got into an accident. You wasted the money. Well, but I had certain peace of mind when it comes to term life insurance that during a time that there would be a need, my family would have been taken care of if I were to die. So it's not wasted in that sense. Renting is wasting money. Well, no, you got the place to live. You just don't own anything at the end of it. We've dealt with that before. Now let's talk about whole life policy. With a whole life policy, you get the death benefit. So we will put that death benefit plus what is called the cash value. Okay? Death benefit plus cash value. When you make a payment to a whole life policy, a portion of your payment goes to what is called a cash value. The cash value will often have a return. So these are completely made up numbers. Imagine that you have a payment of $300 per month for a whole life policy. It might be that $280 per month goes to the death benefit, $20 a month goes to the cash value, and that earns interest over time. Okay? So $20 a month is $240 for the year. And imagine that the cash value is going up by, 5% per year. Over time, you are going to have a larger and larger cash value amount. It grows on a tax deferred basis, and you can take that cash value out if you want. You're also able to take a loan out from your policy, but this will lower the death benefit if you don't pay the money back. Loans from your policy are tax-free, but you've got to pay income tax on the investment gains from withdrawals. Whole life, when you take out a policy early in life, you're really overpaying for the insurance part. So if you compare, for example, the same $500,000 policy that you might only pay $20 or $30 a month for when it comes to term, you could pay anywhere from 5 to 15 times that to get a $500,000 benefit in whole life, right? So you could be talking about anywhere from, $100 to $300 a month for that exact same $500,000 benefit, if not more, depending on a lot of other things. There's also restrictions. There's a surrender charge of up to 10% of the cash value if you want to walk away, et cetera, et cetera. Now here's where my bias comes in. Whole life is extremely profitable for life insurance salespeople. And I know this because I actually worked in this field briefly before deciding it is absolutely not for me. I was licensed to sell whole and term and health insurance in the state of Massachusetts, where I did an internship when I was growing up. And it is extraordinarily profitable for the salesperson who is selling the whole life policy. They get paid a commission on the basis of your first year of premiums. If your first year of premiums is $240 on a term policy, versus if the first year of premiums is $1,200 or $3,600 for the year, which one do you think they're going to make more money on? And the life insurance industry has come up with so many talking points about how great it is to invest in whole life. They go, listen, you set up the death benefit, plus it's an investment. You build cash value. If you ask them, they will give you the table that will actually answer a very simple question. After how long will the cash value equal what I have paid in premiums, right? Your first year, you might pay $2,400 in premiums. You'll have a couple dollars of cash value in some cases, a few dollars. After the second year, you'll have paid $4,800 in premiums. Eventually, the cash value will catch up to your paid in premiums. It takes a really long time. If you speak to any fee-only financial advisor worth their salt, they will tell you, do not get whole life insurance. The way to do this is determine, do I have a death benefit need for a certain period of time? Is it 20 years to cover a mortgage? Is it 18 years to cover a minor child? Whatever it is. Get the term policy and then invest the difference in investments you control at extraordinarily low fees. In this particular case, you would say, well, let's say the whole life policy would cost me $200 a month and the term policy costs me $20 a month. Take that $180 a month times 12 months out of the year times what might be a 20-year policy. Invest that yourself in the ways that I have pointed out. It is almost never justified for the average person, even for relatively wealthy people, to pay the higher premiums for whole life on the basis that it's an investment. And there are unique situations for uber wealthy people where it can make sense. For most people, it doesn't. Go with term if you need it and invest the rest.